February wasn't a good month for MYEG. The company was hit by a double whammy due to some policy changes. At one point, the share price has dropped to 60 cents level, which is more than 30% in just a few trading days. On the other hand, ChatGPT. I know ChatGPT is overcovered and it is not exactly what happened in February, but hear me out. There has been some recent development in ChatGPT that presents a good investment opportunity to us. Hi everyone, I'm Mr. Ted from The Modern Reminder. Welcome to the Market Highlights. In this series, we would update the interesting event that happened recently and see how we can position our portfolio according to these events. In January, we downgraded Malaysia banking sector and also the Hang Seng Index. As we can see here, over the past month, both indices have experienced some correction. To clarify, we are not bearish on these indices, we just thought that a correction was imminent. We are still waiting for a better entry opportunity. Now let's see what happened in February. In early February, Immigration Department Director General announced that all the immigration processes and services will be fully back to the department management by 2025 through the implementation of NICE. That is not all. Few days later, Transport Minister announced that private vehicles owned by Malaysians no longer need to display the road tax. As we all know, these statements sent MYEG share price crashing to 60 cents level. I'm not going to talk about MYEG as a whole because it is going to take a long time. I'm only going to analyze these two particular events. When this kind of event hits, the first thing to do is to estimate how much will it impact the company. But here's the problem. You can see different projected impacts from different sources. Why is that? Because nobody knows for sure. In investment, we are always dealing with uncertainties. If things are certain, there wouldn't be any opportunity to make money. We don't know for sure, but we can play with the odds. First, we look at the Immigration Department, NICE, which is expected to take over the immigration services by 2025. Off the top of my head, I have a few questions to ask. First, can NICE be up and running by 2025? I doubt so. Just few days after the announcement, media reports has labeled NICE as a sick project, as power abuse was suspected in awarding the project. An investigation is already being carried on, which implies there's going to be a delay in the project. Second question. Even when the system is up and running by 2025, will all the immigration services including foreign worker visa, work permit application, work permit renewal be fully back under the department, no longer available in MYEG portal? For now, this is what the Director General said, but eventually it depends whether the new system, the NICE, can handle the traffic volume. Third question. Even when the system is up and running by 2025 and with all the immigration services processes fully back under the department's control, will people still go to MYEG portal for it? This is a very important point. MYEG provides the ancillary services like foreign workers insurance, foreign workers accommodation and job matching, all of which the Immigration Department does not provide. And it is these ancillary services that contributes more to the group's revenue. As you can see in the immigration segment, the ancillary services contribute 37% to the group revenue compared to 8% in the renewal. One might argue that without the renewal services in MYEG portal, the existing user will stop using MYEG portal at all. That is possible, but let's not forget that MYEG has been providing the immigration-related services since 2010. So the data and ecosystem of MYEG in this area should not be underestimated. Then we move on to JPJ announcement. With the introduction of the new MyJPJ app and e-road tax, we understand that road tax renewal can still be done through the existing channel, which is MYEG portal and also the post offices. Why would it pose a threat to MYEG then? I guess people go to MYEG to have their road tax renewed and delivered to them to save the hassle of going to JPJ. And if we no longer have to present the physical road tax, we would just use the MYEG app to renew it. Again, I start asking myself question. First question, will people ever adapt to the e-road tax? Even though surveys suggested that most people still prefer the physical road tax, I believe that most MYEG customers in this segment are from the bigger cities. It will be easy for them to adapt this e-road tax. Second question, if I can adapt to the e-road tax, why won't I just use the MYEG app to renew my road tax instead of going to MYEG portal? The answer is straightforward. If MYEG app can handle the traffic volume, then I will just use it to renew my road tax. But so far, according to various social media sources, the user feedbacks on MYEG app has been very terrible. The third question, if MYEG app improves in the future, will people still prefer the more integrated MYEG portal? Just like the immigration department, the MYEG app does not provide the ancillary services like motor vehicle insurance. And again, it is these ancillary services that contributes more to the MYEG revenue. As you can see here in the road transport segment, ancillary services contribute 28% to the revenue compared to just 7% of the road tax renewal and delivery. After you break down everything, you will know that a drop of 30% in share price was unwarranted, at least with how the things going on now. I understand that by the time this video is posted, the share price has recovered to 76. In my opinion, if NICE will be up and running by 2025, and if both the NICE and MYEG app can handle the traffic volume well, I think a 15% to 20% discount in share price is considered fair, which will translate to a share price of 75 cents to 80 cents per share. Of course, this does not include other positive catalysts in MYEG, which is not included in today's topic. It is worth noting that after the two announcements, MYEG has performed share buyback of 60 million units, and T.S. Wong, its co-founder and managing director, has purchased 42.5 million of MYEG shares. Now we move on to ChatGPT. Look at this graph. It took ChatGPT 5 days to reach 1 million users, 40 days to reach the 10 million user milestone, and it is believed that it has reached 100 million users in February 2023, which is last month. Sometimes when you try to use ChatGPT, you will get an error message like this. It means that the server is currently too busy to handle your request. It happens when the server is under unusually heavy load, and this is where our opportunity lies. You see, modern chatbots like ChatGPT, they use machine learning and AI techniques. They rely on huge databases of information to provide quick, accurate, and useful response to the users. It requires huge amount of data storage space. Second, significant computational power and resources, which will lead to increased demand in data center. And I'm not just talking about ChatGPT. Ever since OpenAI launched ChatGPT, the user growth has been phenomenal. Microsoft has invested another $20 billion in OpenAI. The other tech giants know that they cannot rest on their laurels. Alphabet's Google invested $40 million last month in another AI startup. Recently, IBM and NASA announced collaboration to use IBM AI technology in NASA satellite data. And as I was recording this, I saw notification that Snap rebuilds MyAI powered by OpenAI GPT technology. Meta also created its own AI team to keep up with the chatbots competition. And it will not stop here. We will see more and more companies jump into this AI bandwagon. We are already seeing some US small cap stocks share price jump after announcing their AI initiatives. We can learn from the history that most investors will not end well in this kind of craziness. Partly because many of these companies are just opportunists, and also because at the end only few companies will take most of the pie, At this point in time, we don't know which company is going to win or benefit the most from this AI initiative. But we can almost be certain that in this kind of environment, we will see highest ever demand in data center. You may look at this digital core REITs. It is a pure play data center REIT operating in US and Canada, listed on Singapore Stock Exchange. What does a data center REIT do? It owns and operates data center and leases them to organizations that need to store and process huge amount of data. The lease will then be paid to the shareholders as income distribution. As you may all know already, REIT's price is relatively stable and usually comes with decent dividend. Digital core REITs is trading below its IPO price, mainly because of rising interest rate. REIT prices usually don't perform well during interest rate upcycle. The yield of digital core REITs is expected to be 5.7 to 6% per annum over the next few years. Well, if you think REITs is too boring for you and you really want to take part in this AI hype, yet you don't know which stock to pick, just invest in this ROBT US ETF. The underlying index is designed to keep track of the performances of companies involved in AI, robotics, and automation with global exposure. I'm not recommending you to invest in it. I'm just saying that if you believe that this AI initiative is the future and you don't have the expertise nor the time to do your own research, just invest in the ETF. That is all for the highlight in February 2023. If you want more information about the digital core REITs or the ROBT US ETF or the MYEG, feel free to reach us. You need to understand that market highlights, the information here are very time sensitive. For example, in MYEG case, we actually reiterated to buy the next business day after JPJ announcement when it was trading at around 60 cents level. So if you want a more timely and frequent update, click the link to the Google form below. Our team will get in touch with you. If you like this video, click like, share, subscribe. Until next time.